Imagine this, you're standing at the fork in the road after your divorce. One path leads to keeping your beloved family home, the other to selling it. 6 months down the wrong path, you're drowning in missed mortgage payments while your credit score tanks. This heartbreaking situation happens frequently. Before making any hasty decisions about your home, it's crucial to understand the real cost behind every option. I'm going to demystify the numbers and show you exactly how to calculate whether keeping your home is affordable, when refinancing makes sense, and when selling might be the most sensible path moving forward. The first thing we want to touch on is the true cost calculation, why your home equity is less than you think. When couples go through a divorce, they often have this number in their head, the equity in their home. It's usually something like, we owe $275,000 on the mortgage and our house is worth $400,000, so we'll have $125,000 in equity to split. Sounds straightforward, right? But here's the reality check. Most divorcing couples overestimate their home equity by 25 to 30%. That seemingly simple math is hiding some expensive truths. Think of home equity like an iceberg. What you see initially is just the surface with significant costs lurking beneath. Let me walk you through true equity versus perceived equity using that typical $400,000 home. The basic calculation shows $125,000 in equity, $62,500 for each spouse if split evenly. But this perceived equity rarely matches what actually ends up in your pocket. First, let's talk about selling costs. When you sell your home, you typically pay realtor commissions between 5 and 6% of the sales price. On that $400,000 home, we're looking at approximately $20,000 to $24,000 in just realtor fees. That immediately drops your equity from $125,000 to about $101,000. Next, consider closing costs. The national average for closing costs is around $6,905. These include title insurances, transfer taxes, escrow fees, and other expenses that are often overlooked. Now, your equity is down to roughly $94,000, but that's not all. We still need to address potential tax implications. This is where things get really complicated. When you're married and filing jointly, you can exclude up to $500,000 of capital gains from the sale of your primary residence from taxes. But as a single person after divorce, that exclusion drops to just $250,000. For example, if you bought the house years ago for $200,000 and now it's worth $400,000, that's a $200,000 gain. So as a married couple, you pay no capital gains taxes on this. But if you sell after finalizing the divorce and your individual gain exceeds $250,000, you could face a tax bill of tens of thousands, potentially up to $40,000 that most couples completely overlook. So let's put it all together. Your initial $125,000 in equity drops to about $94,000 after realtor commissions and closing costs. Split between two people, that's $47,000 each, not $62,500 you were expecting. And with capital gains implications, your take-home amount could be even lower. In my experience with divorce cases, I routinely see miscalculations happen. Couples fight both tooth and nail to keep a house based on equity numbers that simply aren't realistic. This reality check isn't meant to discourage you, but to help you make decisions based on accurate numbers. This calculation becomes the foundation for every decision about your home during divorce, whether you're considering a buyout, refinancing to remove your ex from the mortgage, or selling to divide the proceeds. What's fascinating is that even when I show couples these numbers, there's often a moment of disbelief. Where did all the money go, they ask. It didn't go anywhere. It was never there to begin with. The perceived equity was just that, a perception, not reality. The next thing we want to talk about is kind of the decision tree, right? Matching your options to your financial reality. Now that you understand the reality gap in your home's equity, I want to share something that might surprise you. Research indicates that 65% of people who fight tooth and nail to keep their family home during divorce end up selling it within 3 years anyways. This statistic reveals the fundamental disconnect between emotional decisions and financial reality. Today, I'm going to help you avoid being part of that statistic. When it comes to your home during divorce, you essentially stand there at a three-way fork in the road. The first one is refinance. Take full ownership by getting a new mortgage in your name only. The second choice is buyout. Purchase your ex-spouse's share of the equity. And the third choice is sell. Liquidate the assets and divide the proceeds. Each path creates dramatically different financial outcomes, and choosing the wrong one could have a lasting consequence on your recovery. Let's be honest, emotions often cloud judgment during divorce. The family home represents stability, memories, and normalcy during a chaotic time, but making this decision based primarily on emotional attachment is exactly why so many people end up selling anyways, often in a worse financial position than if they sold initially. Before considering keeping the house, you need to pass the refinance qualification checklist. First, Can you qualify for a mortgage on your own? Lenders are going to examine your individual income without your spouse's contribution. You'll need a credit score of at least 620 for most conventional loans, and the most critical factor is your debt-to-income ratio. 28/36 is the typical. However, on conventional loans, it can go up to 50/50. Here's how it works step by step. Calculate 28% of your gross monthly income for housing costs. Step 2 would be calculate 36% of your gross income for total debt payments, and that's going to include your house payment, your credit cards, student loans, as well as personal loans. Number 3, stay under both thresholds to qualify. If you make $7,000 monthly including taxes, your mortgage payment including taxes and insurance should not exceed $1,960. Your total monthly debt payments shouldn't exceed $2,520. Many focus on making the mortgage payment. Homeownership comes with ongoing costs, 1 to 4% of your home's value annually. On a $400,000 home, that's $4,000 to $16,000 yearly for maintenance. Can your post-divorce budget handle a sudden $5,000 roof repair? These unexpected expenses push many divorced homeowners to eventually sell. Timing matters in your decision. Selling typically takes 3 to 6 months from listing to closing. Refinancing typically takes 30 to 60 days once you're approved. Buyout arrangements vary widely depending on your arrangement. Let me walk you through some real-world scenarios. Scenario 1. Sarah earns $85,000 annually with minimal debt. Her mortgage is $275,000 on a $400,000 valued home with $20,000 in savings. Though terrified of changes, Sarah's income supports the payment and she can use a cash-out refinance to buy out her ex's share. Scenario 2. Marg makes $65,000 with $25,000 in student loans and a $450 car payment. Their home is worth $350,000 with a $250,000 mortgage. Despite his attachment to the house, Mark's debt-to-income ratio is too high. Selling allows him to start fresh with a more affordable housing payment. And now scenario 3. Jennifer earns $95,000 with minimal debt, but the home needs significant repairs and she travels frequently. Despite having the financial capacity, the maintenance demands don't suit her lifestyle. Selling remains her best option. Here's a simple formula to determine if you can afford keeping the house. Calculate 28% of your gross monthly income. So track your monthly mortgage payment, property taxes, and insurance. From what's left, set aside $200 to $400 monthly for maintenance. If the result is positive, you may afford the home. If negative, selling is likely better. We've covered a lot today, but at the end of the day, divorce is about building your financial future. Amy Colton, a respected certified divorce financial analyst, emphasizes it's really important to monitor your credit rating during the divorce process to make sure you don't get zinged. This directly impacts your housing decision. Don't wait until financial situations deteriorate. Take action now. Click the link below to schedule a time with me and my team, and we'll help you determine whether refinancing, buyout, or selling makes the most sense for your circumstance. Download my free divorce home decision calculator from the link below. This personalized tool will guide you towards decisions to support your long-term stability rather than just immediate comfort. Your future financial security starts here. I'm David Zai, Mortgage Guy. Thank you for watching this video, and I'm out.